Welcome to The Finance Files, a podcast hosted by best friends Brittany Carter and Whitney Coford, with occasional appearances from Whit's dad, Greg Coford, and other guests.
We talk about all things finance, including investing, trading, economics, capital markets, and business management. Come learn the investor mindset with us.
And friendly disclaimer, this podcast is not investment advice. This is purely for entertainment purposes. Be sure to do your research before you make any investment decisions.
We're your hosts. I'm Whit.
I'm Britt.
And we're here with the Greg Coford to do a Way Back Wednesday where Brittany's going to tell us a little bit about diversification and its history.
Okay, and then we'll get into some fun way back stories, way back when Greg worked with billionaires. So if you're bored with my archaic factoids, we will get to some just juicy billionaire stories after. Okay, that sounds like a reality TV show or something. Like, we're gonna get into it. All right. Anyways, so I was trying to figure out like what are the origins of the whole concept of diversification, and Winnie and I got into a whole philosophical, like biological thing about diversification, but just to put some hard like humans intentionally diversifying piece. Again, we're going to go back to agrarian roots. So the concept of diversification began as early as 6000 BC, and this was through crop rotations. So farmers understood the importance of rotating their crops throughout the year, as well as diversifying which crops they had. This has a lot of benefits, which I won't nerd out on. Fun fact, I did like a mini farm stint, so I'm going to avoid going too deep down the rabbit hole. But long story short, you want to diversify your crop because a heat wave might take out your lettuce. Like, who knows? Like, there's all these things that impact your crops. So you want to diversify, and it also reduces the number of pests that can come on the farm. So this concept of we need to diversify to protect our assets and our livelihoods was very much all well and established in 6000 BC. The first concept of using this from an investment standpoint is somewhat attributed to John Keynes. He managed the endowment of King's College, Cambridge. So he had a stock selection strategy similar to what we now call, value investing, and having a more diversified portfolio, where he looked at having assets with opposed risks, so that when the general fluctuations in the economy occurred, he was able to still retain the holdings. So he was kind of a pioneer for international diversification. So we talked about diversifying geographies. So typically people in the UK mostly just held UK stock. He was the first one to say, hey, I'm going to add substantial non-UK stocks so that we can make sure that we're protected when the UK economy fluctuates. And this whole kind of mindset was more so pushed and became common. I mean, honestly, it's kind of common sense at this point. But that was through the economist Harry Markowitz in the 1950s. So honestly, not that long ago. But his work really pioneered this more modern portfolio theory of having a really diverse range of geographies and different asset classes and industries that you're investing in to help protect your overall investments.
I like the parallel of biodiversity with, making your portfolio diverse. And I think it's a good parallel because you mentioned it's a good way to protect yourself, which is also a big point of diversifying within your portfolio or your investments. The other thing it does is, and I live on a farm. My partner works in agriculture. And the other thing it can do is it makes it across the board, it will make your crops and your plants stronger, because it's going to attract, it's not only going to help prevent disease and different pests, but it will attract the good bugs and the good animals, right? So, bees and that kind of thing that are going to just really make your yard or your garden or your farm extra successful. So I like that parallel of why is diversification important? And I think that's why it's to protect and strengthen your portfolio.
When
So,
you see that with the companies, like there's all these studies now showing the importance of diversity of diversity within the within companies themselves, right? Because they're able to have different perspectives, be able to hedge things that, if you just have a singular mindset within a company, you might overlook. So, curious, Greg, what are some fun stories from the trenches way back when with some of the billionaires?
eons and eons ago.
Well, staying in the agriculture theme, I do remember one family where one of the individuals involved decided to buy a large herd of cattle as a diversification, and he wanted to own cattle, and he wanted to have a ranch, and et cetera, et cetera. Turned out to have a pretty good tax benefit as well. So his siblings decided that they wanted to be in the cattle business as well. So everybody rushed out and bought a herd of cattle. But the rest of the family was not as adept at managing the cattle. And it turned out that the operating losses far exceeded the tax benefit. And so then they, in essence, had to consolidate the management and have somebody that knew what they were doing, run these cattle. So,
So I guess there's actually two lessons in that story. The first
yeah,
lesson is stick with what you know, and the second lesson is don't just follow the hype or what someone says you should do. Do your own research and make sure you know what the potential pitfalls are.
I
sure.
just love too, like this is like the billionaire element of like jumping on the bandwagon or cattle wagon, whatever. Like, like with your friends, it was like everyone was like, oh, we're all gonna invest in crypto. And with the billionaires, it's, oh, we're all gonna buy ranches.
We've just been watching Yellowstone, and so that's like a very timely example of because it's the same thing, right? It's what year would that have been, or like approximately what time
That would have been in the 80s.
in the 80s? Okay, yeah, because I it'd be interesting to look at too because Yellowstone it's based on part of the show is based on a Texas ranch. And that ranch actually got sold after the woman who owned it passed away. It was like part of her will that it would sell instead of passing to her daughter. And presumably it's because the daughter didn't want to keep running it. But also maybe cattle farming is falling off. Who knows? So that's funny.
How do you think billionaires approach diversification within their portfolios?
Well, it's again, it's going to come down to risk appetite, and it's also and that also is going to be impacted by age. In other words, if it's a billionaire that's 90 years old, they're basically going to be 100% in fixed income because why do anything else? Um, on the flip side, if it's somebody young, then I think there's a opportunity to do some significant investing that could have some very beneficial impacts. But my observation has been most of the time, the guys who are at that level either are very cognizant of their limitations. In other words, if they're going to invest outside of an area that they know, they're very quick to draw on experts or people that they trust that know about that area. Or they stick in an area that they're comfortable with and know pretty well.
So, in your experience, it sounds like the billionaires actually tended to be somewhat risk averse in the
Yes,
sense that they were taking sometimes calculated risks, like, but also, um, yeah, they were sticking with what they knew and making sure that they had done their research.
yes.
So is the cattle example, that's just an example of maybe one of the riskier things that they did?
Yeah, yeah.
Okay. What's an example of a time where, either with the billionaires or in your own portfolio, where diversification paid off, where it either protected or improved the return?
Um, there, through the crash of '87, there were a lot of funds that literally blew up, and the clearing agencies for them, the different prime brokers, ended up with those portfolios on their books because they had lent money against those portfolios. And so they were looking to liquidate those portfolios. And the firm that I was with made quite a bit of money through the crash of '87 because we were well diversified across a large array of industries.
And just backing up a little bit, what caused the crash of '87? Since that was before my time.
Okay. So the crash of '87 was caused by a number of factors, one of which was that prices of companies at that juncture had risen to a point where, on average, it was unappetizing for large companies to make acquisitions of other companies as a method of growth. And the other thing that was going on was you had the introduction of what was called portfolio insurance. And the idea was that you would hire a company who would provide you quote unquote insurance on your portfolio. And what they would do is, in a declining market, they would sell futures. So if the market continued to go down, you wouldn't lose as much, or you wouldn't lose anything, depending on many futures they sold, because your portfolio was going down, but the short futures would be making money.
Is portfolio insurance still a thing today?
No.
Yeah, I was going to say it sounds like it might have been short-lived.
Yeah, and the reason it was short-lived is one thing that the portfolio insurers didn't factor in was the illiquidity that occurs when you have large panic selling in a market. And they were the large panic sellers.
Wow, they caused their own demise.
Yes, basically. Yeah. Yeah, our guys that were in the pits, through the crash of '87, normally what would happen is, the futures would trade back then. 1 to 10 contracts was no problem. 10 to 50 might take a little bit. Anything over 100 was just really unusual. And you'd either have to spread that out over time, or you would have to work with a broker to find somebody who would take the other side and then put up the trade. Well, these guys, the portfolio insurers, hit a point where they were offering 1,000 lots at any price, 5,000 contracts at any price, and there were no buyers.
And so going back to the cause of the crash, it was basically companies just got super overvalued.
Yeah. So what happened is, one of the things that drives prices is M&A activity. Companies buying other companies drives prices up. Another thing that drives prices up is companies buying their own stock. Well, when stocks get it highly valued, then companies tend not to buy their own stocks, and others tend not to try to buy them. And so you don't have this impetus to push the market ever higher. So that disappeared, and so the market was, a little bit concerned, and then the portfolio insurers kicked in as a result of a declining market, and it just turned into literal a death spiral. Because the lower the market went, the more futures the portfolio insurers needed to sell.
And this goes back to this time is not different, right? Like a crash in a broad strokes is basically caused when things get overvalued, and then it's going to come back down.
And then all around you, you've got different funds blowing up because they were over leveraged and the securities they owned dropped in value. And so their clearing brokers or their prime brokers would shut them down with a phone call. And then the prime broker doesn't want to own the portfolio. So they're trying to sell that so that
Right.
they don't lose even more money. And so
Right.
it's just blood in the streets.
I love the idea of not always looking like people say like recession or depression, but I think it's almost better to always look at it as a correction, right? It's right. Like if we were making, and obviously like everything's always going to be somewhat speculative and subjective in terms of like stock prices, but a lot of times it's just because things are getting overvalued. But I do think there also is this element of like, uh, are there not the right regulations in place to keep these more secure, right? And it sounds like that kind of happened during the 2007 recession with like housing loans. Like, I mean, the people were getting houses that should not have been getting houses. But then, Greg, it sounds kind of like what you're saying is like these insurance it seems like it's, and tell me if I'm wrong, it just seems like a lot of times it's these like bigger groups and companies, like whether it's the insurance companies or the mortgage lenders, that they just do something that's like high risk and kind of almost gets, I don't know if hidden's the right word, but it's not readily apparent to others in the market. And that's what's causing some of these. I'm curious if you think there's like an element of that, or if it's more always like just a correction of the overall market.
Well, the 2007 was driven by the utilization of mortgage backed securities. And so what you had is traditionally the originator of a mortgage was also the owner of the mortgage. And so they wanted to make sure that whoever the borrower was of decent quality. But when you're just shoving those into a mortgage-backed security, the originator doesn't care so much about the quality. What they care is the rating that they're going to get on the mortgage-backed security. And that's how you had people ending up with, you know, owning far more homes than they could afford or justify on their income or asset basis, is because the originators made money on the origination and didn't care about the quality. And the guys making the mortgage back didn't care about the quality. And so it just built up and built up and built up until, it imploded.
Yeah, it's kind of like an aspect is the law of unintended consequences. Like the portfolio insurance didn't, obviously, that's not what they intended to happen, but it did. And then, same thing in 2007, the people who were structuring this didn't intend to cause a crash, but if you look at where the motivator is or what the driving force is, then it can become more apparent what's going to happen. So, and I think that really underscores both crashes and looking at history, the importance of protecting yourself, and that's why diversification is important. Is it's the best way to protect yourself personally from maybe some of these, potential macro things that are way outside of our control.
Well, and way outside of our scope of understanding. I mean, there were so few people that predicted these from
Right.
ever occurring. So I think it really just, yeah, underscores like if you look way back, if some of the smartest people in the world did not figure these things out before, the chances of you, a layperson, figuring it out are very low. So
Right.
diversify.
Diversify. All right. Well, that's all we have time for today. So join us tomorrow for Think Like an Investor Thursday. Thanks for joining us on the Finance Files.